Hello, good morning, guys. Merry Christmas to all the Christian brothers in the house. It's been wonderful celebrating the birth of our Lord Jesus Christ. It's a wonderful thing to live from January till December to see this wonderful day. Many people who started the journey of 2018 were not able to accomplish and get to this point. We are grateful to God. Okay, I am Simeon Agachi, your practical forex trainer. Okay, today we are going to be talking about indicators. On the previous videos I showed us, I gave us introduction to technical analysis, and I said we were going to do introduction to we are going to start using indicators from the next upcoming video. This video was supposed to come previous day, but I had some good noisy background and I could not submit it. I could not upload it to my YouTube channel. I tried uploading it on WhatsApp. It did not work. So today we are going to be talking about that's one of those indicators. Why do you need indicator? Before we get there, let me show us something very quickly. In technical analysis, generally we talk about your activity, the activity of the market generally, while the fundamental analyst relies on news, reading of volumes of news and getting information, fix, forecasting, breaking news and all of that. The technical analyst doesn't need to do much of reading. All he has to do is analyze the price actions, what happened in the past, what is happening presently, and be able to tell what is going to happen in the future. So that's the duty, that's the job of the technical analyst. Okay, so the technical analyst tends to, with the help of uptrend and downtrend, also tell what the market will do. So on an uptrend, we talk about higher highs, higher highs, and higher lows, higher lows, higher lows, higher lows. Okay, uptrend, you talk about higher highs, higher highs, higher highs, higher highs, higher highs, and higher low, higher low, higher low, higher low. So that's uptrend on the technical analysis. Then on the downtrend, you talk about lower highs. See a high here, lower high, lower high, lower high, lower high, lower high, lower high. Then you talk about lower lows also, lower low, lower low, lower low, lower low, lower low, lower low, and that's it. Now in the market, you are actually, everything you do about forex is to help you get good entries and good exits. The candlesticks alone are not enough to help you get better entries, to help you tell when the market is being oversold and overbought. Okay, that's it. Today we are going to be talking about relative strength index. Why do you need the relative strength index to trade forex? We want to use it to determine when the market is being overbought and oversold. A market is said to be overbought when it has been on an uptrend for a long or a short period of time, and at the zone it begins to show signs that it wants to reverse. So the moment you begin to see signs that it wants to reverse, you are going to go short, you sell along to make profit. But to determine whether the market will reverse or not, to be accurate in your determination, you cannot do that with the candlesticks alone. You need the relative strength index to do that. If you see that the market is being on a downtrend for long, okay, that is called an oversold market. So how do you know an oversold market? You know an oversold market when with the RSI. You cannot know that with the candlesticks alone. So you need the relative strength index to know when the market is being oversold. So the relative strength index will tell you that this market is being oversold. Go ahead and go long. Okay, little history about, just not history, little historical antecedent about the relative strength index. The RSI was created by James Wallace Wilder. James Wallace is spelled as Welles, Then Wilder is spelled as Wilder. So James Wilder was a real estate investor and first made the RSI public in the year 1978 on a book he wrote on financial trading analysis called New Concept in Technical Trading System. So James Wilder found the relative strength index in the year 1978. Okay, now the reason for this was to tell when stocks were oversold, when the market was to say to be oversold or overbought, and then enable investors know the next action to take. So the relative strength index is under the indicator genre called oscillators. You see oscillators here. You see under oscillators, you see the relative strength index. Okay, now let's get to action. How do you use the relative strength index? Don't get confused by all these things on the chart. They are not part of the chart. I just marked them out for tutorial sake. Okay, I want you guys to understand this, get me right, get every point I'm gonna make. Okay, so let me get to the beginning of this chart where I stopped my analysis to make it easier. We getting there. Now don't mind this double line. I'm a musician. I'm a classical versus contemporary musician. In music piece, we use double lines to determine and tell the musician who is sight reading or sight playing that this music is ended there. So I use it to mark my chart to know that, to remind me that this is where my analysis ended on the chart. So we are going to start here. Under the chart, you see below here, this is the relative strength index. This line here, this green line here is our RSI, relative strength index. What is your setting for the relative strength index? You just go here, oscillators. Under oscillators, pick relative strength index. Come here, set your fixed minimum to 0 and your fixed maximum to 100. After that, you say, okay, but I'm not going to do that because I already have one. I don't want to have double relative strength index, so that you don't get confused. So all these vertical lines on the relative strength index are not part of it, like this red one. I marked them out for tutorial sake, like I said in the beginning. Good, let's get to action. When you look at the relative strength index, each time this relative strength index hits the line 70, you can see there are two lines here. There is 70 here, there is 30 here, there is 0 here, there is 100 here. The 100 and the 0 are not our zones or points of interest. Our point of interest is the 70 and the 30. Each time the RSI hits the 70, it simply tells you that the market is being overbought and might reverse there. So more often than not, when the RSI hits line 70, the market will reverse from there and sell. It will go short, it will go bearish. When the RSI hits line 30, it shows that the market has been overbought, it wants to reverse. So more often than not, when it hits 30, the market will go bearish, price will drop, and when it hits 30, the market will go bullish. Price will rise, and people who bought at that zone will make profits. Okay, so when it hits 70, the market is showing signs that it is being overbought and will likely drop from there. When it hits 30, it is showing that the market is being oversold and will likely rise from there. So let's start with the things I marked out in the chart. Each time you see an entry point, on my marking out here, it shows that the RSI hit it at 70 or 30. On this zone, on this point, the entry point here, the RSI hits line 70. What happened? We saw a drop. You see, the candlestick works in line with the RSI. Anytime there is RSI zone where the RSI hit 70. Look at the candle, look at the market, look at the chart. That zone also will be up, like you can see here. See it. See, there was a rise here, and giving us even a better entry, we got a shooting star. You know what I talked about shooting star and hammer on the other video. So each time you see the RSI hit 70 and then there is shooting star, is even a better confirmation for you. That market will go on a downtrend. That market will go short for a while and you make some good profit. What did we see here? Let's see if that's actually true. RSI hit 70 here. We saw a shooting star here. What happened? We went all the way down. The market went all the way down, not us. If you traded with the market, then you also went all the way down. So people who sold here, because RSI hit 70, they knew that it was going to reverse. They also saw a shooting star. That was a stronger confirmation that the market would go short. They now went ahead, sold all the way down, took their profits here. What happened? They made over 195 pips. You know what that means? If you were trading with standard lot size, that's $10 per pip. You'll be multiplying $10 times 195. That's a good trade. So each time, though I didn't mark out this point, I didn't actually mark it out. I can still do that. I can still do that. Let me mark it out here. So each time you see a candle, the RSI, I'm explaining both ways. Anyway, I see RSI hit 70, I will explain. Anyway, I see it hit 30, I explain. When it hit 70, I explain. So here it hit 30. What did we see? We saw that it rose from here. See it. It hit 30. So the candle also came down alongside to show that it hit 30. What happened from there? We saw a rise. RSI rose to the zone. The market chart, the price rose to the zone. So anybody who took a buy from here, from this zone where the RSI hit 70, anybody who took this would have taken their profit at this zone. This zone, this is where they would have taken their profit. They made some good profits, some good one. So this should have been their entry, their exit point, their take profit. So let us see how many pips they made if they took this buy from there. Let's see how many pips they make. They made 122 pips. Wow. That means if the persons who took this trade from there used standard lot size, that's they had a $10,000 account with leverage of 1:200, they'll be making like 122 pips times $10. You know what that means. So RSI here hits line 30. What did we see? And not just hitting 30, we can see that we had a hammer here. So each time you see RSI hit 30 and there is a hammer, the market, that is a good confirmation that the market wants to reverse. The market has been oversold and wants to go long. It wants to go bullish. As we can see, we saw here RSI hit line 30, and a part of hitting line 30 on the same zone we had a hammer. What happened? Let's see how many pips we got from this trade. The market went all the way up, See, we had 757 whole pips from that rise, because what happened, we saw that RSI hit 30 and there was a hammer on the same zone. So the rise was eminent, the rise was huge. So it kept rising from there until it got to this point. So people who took their profit at this zone made 757 pips. So even you had a $10,000 account and traded with 700 and traded with 1 standard lot size, you'll be making like $10 per pip. So 757 multiplied by 10. You know what that means. See another entry point. I'm done with that one. This is RSI hitting 30. It hit 30 here. You see, right? So anytime RSI hits 30 and you see a hammer, man, it's gonna pull up. So you go ahead and buy. You see, we saw it hit 30 here. We saw another hammer. The market went all the way up. Came here. See it from here. Don't get confused. I'm only doing this for tutorial sake. It went all the way up. You see, people who took it from here, RSI hit 30 and gave us a hammer, issued a hammer here. They exited at this point. You can see that. Now let's look at this. We can see another entry point here. RSI hit 70, and what happened again? We saw shooting star here. Oh, great move. What would you have expected when you saw that the RSI hit 70, and amidst hitting 70 we saw a shooting star here? What happened? The market dropped drastically. It was a good downtrend. It was a good bearish move, which gave us about 33 pips. That was a good one. It was a very good one. See another entry point where RSI hit 30. What were you expecting? A rise, of course, a rise. What happened? We saw the rise from here. It went all the way to this zone. Okay, let's take it and see how many pips that was. So people who saw RSI hitting 30 here and saw a hammer took this trade from here. So they rolled it all the way up to the zone. How many pips did they get? 45 pips. Okay, 45 pips. Then RSI also hit 70 here. Issued a shooting star here. So anybody who took this trade here or here had profit driven down here, profit taken here. Okay, so both people who are looking for long-term trade can use leverage on the RSI. Okay, now if the market has been on a downtrend for long, and RSI hits the 30, and then issues a hammer, it will usually, most often than not, go also on the long trend, on an uptrend for long. If the market had been on an uptrend for long and eventually hits line 70 and issues shooting star, it will more often than not also go on a downtrend for long. See this one. We saw 30, RSI hit 30 here, and then we also saw hammer. It gave us hammer, but not a perfect one. What did we see? An uptrend all the way from there to this zone. So let's see how many pips we made from that trade if we had taken it. How many pips did we make? We made 259 pips. That's huge, very huge. 259 pips is what we made from that trade alone. That was good. Okay, see another one for scalpers who made this one here could have leveraged on it. You see this hammer, so took it all the way up, and let me mark it up so that it will be easy for you. They saw it here, they took it up, also rode along, and then took their profit here. See, so that's just it. Scalpers who met this market here, this zone, what did they do? They took it up from here, bought, and then took their profits here. What happened again? What still happened again? Scalpers who took this trade from here. Sorry guys, let me pause this video and take a call. Alright, sorry guys for that break. That call was a good one, a call I've been expecting. Thank God. One of my debtors and friend who's been owing and doesn't want to pay. I've been finding it difficult to trouble him to pay back, but I think God is arrested him and he's talking positive now. So let's get back to what we're saying. Like we can see here, RSI hit line 30, and what happened? It went all the way up. So guys took profit here. RSI hit line 30 here again. Scalpers leveraged on it to profit here. So we can just go on and on and on. 30 was hit. You can see it rose all the way up to this zone, So people took profit here. So that's it. Whenever you see that the market has been on a downtrend for long, and eventually RSI hits line 30, and then lucky enough it issues a hammer, what is gonna happen? We will see a long uptrend. So let me give a perfect example of this one. This one, the downtrend from here to here was long. It gave us over 33 pips, as you can see. Let me take this thing out from here. It gave us over 33 pips. That was a long downtrend. What happened? It came to this zone. RSI hit line 30, not just hitting 30. We saw a hammer. So usually what should happen when a market has been downtrend for long and RSI hits 30 and we see a hammer again? You see three good confirmation. It's been on a downtrend for long, RSI hit 30, and we see a hammer. What do you think? It's gonna go on a long trend for long too. Isn't that what happened here? Let me mark it up to make it easier for you to see. It's gonna go up on a long trend, on an uptrend for long. That's still what happened. You see the uptrend. The uptrend was long. Let's see where this uptrend ended up. This uptrend was long, man. You see where that uptrend ended. How many pips? 38 pips. 338 pips from that zone. Why? Because the market prior to that RSI hitting 30 was on a long time downtrend that was over 33 pips. And when it got to 30, when RSI hit 30 and gave us a hammer, we also expected a long uptrend again, reversal, where we saw that long profit. So so that's it. See long downtrend. What did we see after the long downtrend? A long uptrend. RSI hit 30, issued a hammer, gave us a long uptrend that came up with over 757 pips. So you can see that after that long uptrend that gave us 770 something pips, what happened again? We saw another long downtrend. Why? Because RSI hit 70 and we saw a shooting star here. What happened? We saw a long downtrend. So this is just it. Anytime you see RSI hit 70, see the confirmations. If you want to go on a long term trade, maybe intraday, you're looking out for, if you want to go on a buy, what are you looking out for? You're looking out for the market to have been on a long time downtrend. It should have been on a downtrend for long, and eventually after the downtrend, if RSI hits 30 and issues you a hammer like this, it will give you a long uptrend as reversal. If RSI was a long time uptrend and hits line 70 and issues you a shooting star, it will give you a long downtrend. So let me give us better confirmation. Each time RSI hits line 70, and you're looking for, we are talking about you were looking for a sell this time. Each time RSI hits 70, okay, and on the high, on the part of that trend, you have a shooting star, and then before that shooting star you have some consolidation like this. Before the shooting star it means you have a long downtrend. Okay, each time RSI hits line 70, line 30, and you have consolidation for a while before you get your hammer, you are gonna have a long time uptrend. So go ahead and buy, go ahead and sell when you see this confirmation. So that's the RSI. That's how to trade it. If the more the RSI tests the zone, the better for you. The more it tests line 30 before reversing, the more stronger buy we are gonna have. If it tests 30, like let me get a zone where I'll give a clearer example. Don't get confused. The more it tests line 30 before reversing, the longer uptrend you expect. You see, this thing tests, we can see 1, it went all the way up, 2, and then it came up. We saw a long uptrend. See, if it tests 30, you're lucky enough, you see that it has tested 30 the same day. 1, 2. If you even have more tests, retests, like 1, 2, 3, or 4, and all of a sudden after like the third or the fourth retest, you saw a hammer. We're talking about if the market was in a downtrend. You saw a hammer after a little consolidation. What do you think? The market will give you a long time buy. Like we have a case like that here. RSI kissed 30, came up a little bit, came back again, kissed 30. We had double tests here. After the double test, what happened there? Consolidation. What is consolidation? When bear and bull candles are struggling within a zone without the market going in any particular direction. That's consolidation. So RSI had tested once, twice here on 30, and then we saw consolidation here. From here to here, we saw consolidation. After the consolidation, if it still gives you a hammer, man, go ahead and buy. The buy is going to be a long one. What did we see? We saw a hammer here. Now let's see from that hammer, let's use a downtrend to determine if we actually had a long time buy, so that it will not be like I'm singing China music. We are gonna see if we actually had a long time buy after all that confirmation. No big grammar, so we'll see proofs. You see, after that confirmation, this is where the market took us to. How many pips? 345 pips. Man, that was a boom. 345 pips. You can see that. So, did I explain well what I said? Was it true or not? Was it true or false? Of course, you will say it is true. On this day, we had like 3 tests again. See another confirmation. Oh, this thing is just getting better. See, 1 confirmation. RSI kissed 30. It kissed it again 2. It came back up, kissed it again the 3rd time 3. And what happened? Though we did not get consolidation, but we still got shooting. We still got a hammer. After the hammer, what happened? Let's see how many pips we got. It was a long uptrend. That uptrend that stopped here and gave us how many pips? And gave us 757 pips. Guys, if you are not learning this thing, I don't know what you want to be doing. This thing is working. This thing is cool. So let's just reverse everything we said. If the market, if RSI kisses line 70 for more than 2, if it kisses like 1, 2, 3 or 1, 2, and then gives you consolidation and issues a hammer, bro, sister, go ahead and sell. You are going to be having a long time bearish market. Let's see if what I said is true. We see that on the same day RSI kissed 70. It kissed 70 once. It came up. It kissed 70 once, came back, kissed it again twice, came back, kissed it again the 3rd time, came back, kissed it again the 5th time. What happened after the 5th time? We saw consolidation here. After consolidation, what happened? We saw a shooting star. That's if you took that trade, we can see a shooting star here. After the shooting star, what happened? The market went all the way down from there to this zone. So from that point to this zone, how many pips was that? 333 pips. So people who took that trade made 333 pips. And assuming you were trading with standard lot size, which is on a $10,000 account with leverage, you'll be making $10 per pip. So if you multiply 333 by 10, you know what that means. So much money for you, so much money waiting for you. So this is just good. That's just it. That's the way it works. This thing works. Learn this thing. Okay, I believe everything here is simple. I like marking out my chart, mapping it up like this for tutorial sake, so that everyone, even a child at 10, can understand what I'm explaining. So that's it for the RSI. One more thing, a trader is not measured by how much he makes a day. A trader is measured by how many pips he captures a day. A trader is not a trader's expertise, a trader's professionalism, a trader's experience and success ratio is not measured by how much he can make a day. It is measured by how many pips he captures a day. Why do I say so? Let me give us an example. Assuming Mr. John has a $10 account and makes 100 pips every day. This is what he would do. He will be using 0.1 lot size. Sorry. Clean it up. 0.1 lot size. That's what Mr. John will be using on a $1,000 account per lot size. Okay, and he makes 100 pips per day. Multiply this by 100 pips per day. How much is he gonna get? He's gonna times that is 100 pips, $100 a day. 0.1 gives you $1 per pip. Okay, so $1 per pip. If Mr. John, who trades on $1,000 account, makes 100 pips a day, it simply means 1 times 100, that's $100 a day. Okay, then Mr. Ambrose trades on a $10,000 account. Okay, his lot size is gonna be one standard lot size because he's using leverage. One standard lot size, and one standard lot size gives you $10 per pip, and he makes only 10 pips a day. Let's see what is making only 10 pips a day. 10 pips a day times 10. How much does it make? $100 a day. That means Mr. John, who is trading a $1,000 account, is making 100 pips and is making $100 a day. Then Mr. Ambrose, who is trading on $10,000 account, is not good enough to capture many pips, so he makes 10 pips a day, and that's $100 a day. So let's assume Mr. John was now given that $10,000 account to trade on, and he will be making that same 100 pips a day on that $10,000 account. What happens? We said one standard lot size is equal to 10 pips per pip. So Mr. John has been given the $10,000 account to trade on, and he makes 100 pips a day. Okay, 100 pips a day. So 100 times 100 pips a day times 10 lots times $10. 100 times 10. Let's see how much he makes. $1,000. So can you see now that Mr. John was making more money, more pips? He's more of a successful trader because he makes more pips than Mr. John, Mr. Ambrose, who was trading on a $10,000 account. So Mr. John can actually be given $100 account, where he'll be making 100 pips a day and be making pennies with the 100 pips a day. You know why? Because the account and lot size is small. While Mr. Ambrose, who is trading a $10,000 account and making 10 pips a day, will be making more money than him, who is trading on the $100 account. You know why? Because the lot size the other man is using is higher than the lot size of the other man. So the man who is trading on a smaller account size and makes more pips and makes less money, if he's given a bigger account to trade with that same number and a quantity of pips he makes a day on that big account, he's going to be making more money. You can see, given this analysis, a trader is not measured by how much he makes a day, but by how many pips he makes a day. I am Agachi Simeon, your practical Forex trainer. Remain positive, remain disciplined, trade without grade, trade with stop loss, and you will remain and do well in this industry. I love you all. Thank you guys. Bye.